Hey everybody, welcome to Mortgage Today for Thursday, October 12th, 2023, and oh, what a day it was. We had another tough start to the bond market today. MBS were down 52 basis points in early trading. S&P futures were up 9 points. Bonds were roughly unchanged overnight in what had been the calmest overseas trading so far this week. Sellers were showing up in moderate numbers after the economic data came in. Core CPI month over month came in up 0.3% on a 0.3 forecast as 0.3 previously. Core year over year CPI came in at 4.1 on a 4.1 forecast. It was 4.3 previously, so not really coming down much. Headline CPI month over month came in at 0.4 on a 0.3 forecast, so actually going up. It was 0.6 previously. And jobless claims came in at 209,000 on a 210 forecast. It was 209,000 previously. Complicating factors include shelter inflation ticking up 0.6% from 0.3% last month, as well as another strong jobless claims reading. Auto insurance is also up 18.9%. Auto repair is up 10%, and food away from home was up 6%, according to these reports. The FOMC minutes were also released yesterday. The majority of participants judged that one more increase in the target federal funds rate at a future meeting would likely be appropriate. The Fed futures took down their bets for a November tightening to below 10%, and while the probability of a tightening in December meeting remained around 26%. We also had a 30-year bond auction where the U.S. sold $20 billion worth of bonds. High yield rate came in at 4.837. It was previously 4.345. Bid to cover ratio was 2.35. It was 2.46 previously. Direct accepted was 16.7%. It was 19.7% previously. Indirect accepted was 65.1 on 64.5 previously. 4.837 result on the 30-year bond auction versus a WI when issued. Yield expectation is quite a bit of a miss. The fact that it occurred when bonds were already selling off makes it even more of a problem. Even before this week's rally began, we knew we'd be on the lookout for brief pockets of lower bond yields. These corrections are common during selling sprees. They serve as a periodic pressure release, but are almost always meaningless when it comes to redefining the big picture trend. Today's sell-off drove that point home and was perhaps easier for traders to facilitate in light of the last 2 days of gains. Still, the selling required a catalyst, and it found one in the core services component of the CPI report. This is exactly the place the Fed wants to see better progress on inflation, and the numbers showed the opposite of progress. MBS closed the day down 64 hurtful basis points, closing at 97.97. Govies fared a little bit better, but at 97.97, that puts us back down in this crappy, ugly range where we're just below the 25-day moving average and really almost no other lines of technical data because it's just that bad. We also got news that the CFPB has announced that it is beginning the rulemaking process to remove medical bills from Americans' credit reports. This is kind of dumbfounding to me. The CFPB outlined proposals under consideration that would help families financially recover from medical crisis, stop debt collectors from coercing people into paying medical bills they may not even owe, or to ensure that the creditors are not relying on data that is often played with inaccuracy. So basically, they've given up on having their authority to make these companies do the right things. So they're just going to take it off of the credit report, which means that, okay, if you receive medical services and you just don't pay, what exactly are the ramifications for that?